Hey everyone, welcome back to Nadlan Forum Podcast Daily. I'm Ruby, and with me as always is Lior. So, the headline this week, mortgage applications down a bit, right? Just slipped under 2% after that big September wave. But honestly, this isn't some doom and gloom kind of drop.
No, not at all. I had a client back in Tel Aviv. He'd call the second he heard the word decline and already think we're headed for a crash. But in the American market, these numbers, they're really more of a breather after all that activity. Application volume is still so much stronger compared to where we were last year. People forget that, Ruby.
Totally. We had, a 1.8% seasonally adjusted dip? And refinance and purchase applications both took a little step back, but it's kind of like after a sprint. You got to catch your breath. Analysts, at least the ones I trust, aren't treating this as a warning sign. The market's still buzzing way more than most of 2024.
Right. And if you break it down, purchase activity dropped by 3%, but is still 20% higher than last October. That's a big deal. But it depends where you look. The improved inventory in some places, those slightly better mortgage rates, that's what's keeping buyers motivated, even as they're still, cautious.
It's the little things, right? I always say 1 week does not a disaster make, especially not with numbers like these. The American data is painting a way less dramatic story than those market panic headlines. So, Lior, do you think this pause is healthy? Or is it something buyers should worry about?
Honestly, Ruby, if you're out there buying or refinancing, minor dips like this are just part of the rhythm. It's not a red flag. We've seen so many ups and downs. What matters is the year-on-year growth and those underlying drivers. Rates, inventory, buyer confidence. Maybe buyers are pausing for a breather, not running away.
Exactly. And the refi stuff's even wilder. Sure, refinancing activity cooled a bit, down 1%, but let's be real, it's still up a whopping 59% compared to this week last year. The September optimism definitely hasn't just fizzled out. It's just leveled. You're still getting a pretty intense refi scene, yeah?
Yeah, and the key is who's actually refinancing. FHA borrowers are really having a moment because those rates are sitting about 10 basis points below conventional ones. So refi applications for FHA loans actually jumped 12% last week, even while everything else cooled. Makes sense if you're chasing every basis point you can get, right?
It totally does. This is kind of funny, but my friend Mia back in Melbourne, she pinged me just the other day. She'd heard about how Americans use FHA loans, especially for refinancing, and was genuinely curious if she could get something like that in Australia. I tried to explain, but our system's way different. But it's a perfect example of the global buzz around these moves in the US. Good rate spreads make everyone sit up and take notice.
Definitely. And we're seeing the mix shift too. The refinance share ticked up to 53.6%, but the ARM share dropped to just above 9%. So, borrowers are saying, no thanks to the risk of rates changing right now. Stability over flexibility. That's a theme I'm hearing from almost all my clients lately.
Yeah, and it lines up with what you'd expect when the market feels a bit shaky. More FHA action, a little less for conventional and VA, and USDA's just kind of chugging along as usual. It feels like first-time buyers or folks with tighter budgets are finally seeing their moment, at least for now. But there's this undercurrent of don't wait too long in case the winds shift, which, let's be honest, totally keeps things interesting. All right, let's talk rates and the big what's next. The 30-year fixed dropped a hair, down to 6.42%, and FHA's even lower at 6.19%. They've been just hovering, not really lurching up or down, since September. Honestly, that kind of calm feels a bit weird after the roller coaster we had earlier in the year.
And I'm watching that closely because if you look at inventory, it's recovering a little. Not fast, but enough to ease things compared to last year. That's helping keep demand up. But the real wild cards are what the Fed's going to do next and where Treasury yields are heading. If yields spike, rates follow. Not much mystery there. We discussed something similar a few episodes back, I think.
Yeah, that was the one where the rates went dead still. Episode 7, maybe? It's funny because back then we said borrowers should act while things are stable. It's kind of holding true. But now, first-time buyers seem way more alert to even tiny shifts in inventory. If you see more options popping up, everyone's like, go, 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 it might not last.
Absolutely. Small improvements in inventory can make a big difference, especially for buyers who were boxed out last year. But I wouldn't call it a flood yet, more like a slow trickle that's keeping the market resilient. There's still that question. Will rates stay this steady, or are we due for a shakeup if the economic signals turn, like inflation or jobs data?
And everyone's watching. I feel like every week it's just a waiting game. When's the next twist? For now, though, the stability is giving both buyers and refi hopefuls a legit window to make moves. As always, we'll keep you updated if that changes. But Lior, any signals or surprises you're watching extra close?
I'm keeping an eye on the Fed's guidance, obviously, and the Treasury market. Also, affordability shifts, even slight ones, could mean a second wave of buyers or refinance activity. So if you're thinking about making a move, staying informed is really the play.
Couldn't agree more. All right, we'll wrap it there for today. We'll be back soon with more on what's moving the market and maybe some more wild client stories from Lior. Thanks for tuning in, and thanks, Lior, for all your insights.
Thank you, Ruby. Always a pleasure. And to everyone listening, stay well, and we'll catch you on the next episode.
See you next time, everyone.